This is a bonus video tonight with the request to understand position sizing and stop losses. And this is just purely based on the math. I'm just doing a quick little Excel spreadsheet here to explain position sizing. If in this case, we'll say you have a $100,000 in trading capital in your trading account. This is your discretionary trading account with all the money you're going to put at risk total. A lot of misunderstandings with the 1% risk. So many times over the last decade, people keep thinking that this is the position size. If your trading capital is $100,000, you can risk 1% of your account on each trade. That's $1,000 of risk. But this is not position size. Your position size could be $20,000. It could be $10,000. Really the risk and the volatility of the underlying and your stop loss really determine what your position size is. So for this example, let's say a stock price is at $100 a share is the current price in the market. And you want to enter here. This might be the break above a key moving average, or it hits your entry signal, whatever that may be. You're entering at the $100 level. Your stop loss is $95. You know, this is where the price will lose its key moving average or its key support, or will break into extremely oversold conditions, or what have you. Your stop loss is where the trade is wrong. Stop loss is really determining your risk inside of a trade. This is what determines the risk side of your risk reward ratio. You have to have a stop loss, so you're not leaving your downside open. You're closing it at this price. So let's say set $95. $95 is your stop loss. So your risk per trade is $5 per share on your entry. You will get out at $95. So you have $5 risk per share. So let's the risk divided by your risk per share. So you can risk $1,000. And you're risking $5 a share on this trade. You have 200 times 5, which gives you $1,000. So that is your total risk per share, but that's not your total position size. Your position size is your shares times your price. So you've got 200 shares in increments of $5 risk. You have 200 shares at risk, so you multiply your shares times your stock price to get your position size. So 200 shares times $100 a share is $20,000. That is your position size, which is 20% of your total trading capital. You know, if your 200 shares drop down to $95, your $20,000 position size becomes $19,000 at $95 a share. So you have lost $1,000, and that would be where your stop loss is triggered. A drop in your position size from 20,000 to 19,000 would be 1,000 lost, which is 5% of your position size. $20,000 is $1,000, which is 1% of your total trading capital. So there's a big difference between your position size, your 1% risk, and your stop loss and your stock price. And I hope this makes it more easy to understand the dynamics of the 1% risk rule and the formulas you use to develop that. Another way to look at a risk would be in a back-tested moving average system, like the Russell 2000 IWM with a 10-day, 50-day simple moving average crossover system, and you're going to enter on the crossover of the 10-day over the 50, and then you're not going to exit until the 10-day crosses back under the 50-day. You have a quantified back test. You can look at the size of your biggest losses here and set your position size based on that. Here's an almost 8% loss. 10.39 might be our biggest one in this data set. Yeah, so you take your maximum loss, 10.39, as your worst case scenario for the last 18 years, and you could say, I'm going to trade this system with a 10% position size. So when you are having a winning trade, here you're up 1%, you're up 2.26% with a 10% position size, but you're down 1.03% on this losing trade. So this system, and then these other ones would be like 0.2%, 0.3%, 0.4%, like almost a 0.5% loss. You would be losing 0.8%. So these will all be under 1% for this system. So this is another way. If you see a system that has a maximum 20% loss, then you could trade a 5% position size. So your biggest loss would be 1%. With 20% of 5% position size would only be a 1% loss. So that's one way to set the dynamics of your position sizing. I hope this helps, and let me know what you think about that as an example. We'll get into the stock charts now.